Hello and welcome to another special 3 in 10 podcast. We're recording this one on Wednesday, February 4th at 5:30 Eastern Standard Time. And the subject of this special podcast is our 2026 strategy outlook. We poured approximately 50 hours of work into this report over 6 weeks. And what we're going to do in this podcast is take 8 or 10 of what we think are the most important charts in the report, riff off of those charts and why we think they're important. And then at the end of the pod, we're going to summarize our findings in the report. It was about 5,000 words. So we felt it was important to summarize it in an audio-visual format for those who either don't have the time or don't have the patience to read the whole thing. But we will include a link to the hard copy report for those who want to read it here in the show notes. I'm going to start with the first slide here, which is our hiker. So this fellow graces the cover of our report this year, just like he did last year. Different scenery, different nuances to the whole artwork here. But we put a lot of time and intention and thought into the covers of our reports because we want them to kind of summarize or get the report started with some of our main conclusions. And the hiker in this one represents endurance, fortitude, and persistency. 3 key ingredients, in our opinion, to successful investing. And for whatever reason, the hiker was incredibly popular. We've written almost 80 different reports here as a strategist at the firm over the last 3.5 years. And without question, the hiker on the cover of last year's 2025 strategy outlook was the most popular we've ever had. So he is in some ways backed by popular demand. I had a lot of phone calls, a lot of text messages, emails about what does this guy represent? What does he mean? Well, he means that he's still climbing. The road has become more treacherous. And there is a summit ahead, but the weather is a little bit threatening. It's not going to be easy. We've had 3 consecutive double-digit up years for the S&P 500, and we think the road gets tougher from here. So that's what he represents. Now, on slide 2, I like to level set at the beginning of the year and talk about the year before, which was 2025. And you can see on the right side of the page that the biggest story was in precious metals and metals in general, whether it was copper up over 40% or gold up 65% or silver, which was up almost 150%. Those really stole the show. They had their best moves in really 2 generations and almost a half a century. And if you didn't have those metals at all in your portfolio, boy, did you miss out on some really enhanced performance. The other thing I take away from this is that almost all major assets did pretty well, except for oil and the US dollar and Bitcoin. But some really big numbers for developed international markets, for emerging markets. The US technology continued to do well. Even bonds did pretty well, even good old-fashioned treasury bonds. The Lehman, or now what is called the Barclays Ag, returned almost 8% total return. So that was the first time in years. So it was a good year for investors. And look over to the left, 2024 was a good year for investors. If I had 2023 on here, it would look like a good year for investors. So we've had 3 good years in a row for returns, diversified returns even. And that's why we painted a little tougher picture for our hiker in slide 1. Now, on the next slide, we have a table here that we clipped from Bloomberg that shows the consensus for US GDP growth in 2026 is about trend growth, 2%. We think that it's going to be much stronger than that. Our estimate for 2026 GDP growth is 3%. And every day that goes by, I get more concerned that we're too low. So we think the street has a long way to come up in terms of their estimates for growth. We think it's booming right now, and we'll talk a little bit more about that. Next slide is our TES model. This is our Tactical Equity Strategy Model. The acronym for that is TES. It's very much in gear as we are in the early stages of 2026. We've got 10 positive signals. We've got 2 negative signals. And that's an overwhelmingly bullish model signal for us. And that just sets the backdrop. We don't fight this model. We've been using this model for over 20 years and modifying it and tweaking it and hopefully improving it over 20 years. And it almost always gets the backdrop generally correct. So this is a positive backdrop for equity investing as we head in to the middle of the first quarter of 2026. Now on page 6, we have a spreadsheet that we created with our forecast, not just for the S&P 500, but with numerous indices that we think are important, because we think the S&P 500, while it is always the most important benchmark, is probably the least important investment in 2026. And we think it's going to lag other parts of the markets. So we give you targets for the S&P up 9% total return. We like to focus on this fourth column here, total return in dollars, because that's what investors in the United States are going to get. So of course, 9% means a little bit better than average year historically, really very close to right on average is what we expect. But if you look at other potential investments here that we've been recommending, equal weight S&P underperformed last year. So far this year, it's getting off to a much better start than the cap weighted S&P. We think that will do around 11% total return in dollars. All country world index, we're strong proponents of diversification outside the United States at this point in the cycle. And we think total returns in dollars will be about 16%. We think about 500 basis points of that 16 will come from dollar depreciation or translation from foreign currencies back into dollars, giving you a higher return for investing outside the country. Emerging markets, our favorite equity asset class for this year, we think you'll do around 25% total return in dollars in 2026. Here within the States, the S&P Midcap 400, we think can produce about 19% total return, small cap 600 after about 15 years of underperformance, now cheaper, growing faster, all around better in our opinion for this year and off to a much better start than the large cap 500. China equities, we throw this in here as kind of a wild card, high risk, high return possibility. We think that can do almost 40% this year in dollars. So my point here is the opportunity set has broadened way beyond the S&P 500 after 3 stellar years for large cap and tech and AI. We think there's a big rotation away from that in 26 toward these other things. Now, on to fixed income. We absolutely think investors should not abandon fixed income. We think it's a critical, vital part of any rational portfolio for all but the most risk-seeking. So I hear a lot of people tell me, oh, I don't do fixed income anymore. I think that's a mistake, because I think all portfolios, even for younger people, need income. They need recession protection. They need diversification and portfolio ballast. And fixed income, high quality fixed income gives you all of these things. We think in the treasury market, you want to stay in the 5 to 7 year sweet spot on the curve. In the report, we get into why, but do not ignore this important asset. And when you think about the coupon on a newly issued 10-year treasury note, it's 4.30. That's a pretty reasonable coupon. And that allows fixed income to do its job again, which is shock absorb portfolios, produce income, diversification, all those things we said. So while we think you're going to get mid-single digit returns in fixed income and high quality treasury bonds, we don't think that's worth ignoring or should be ignored. Now on to the dollar. Probably our biggest call and strongest held belief last year was that the dollar was beginning a bear market. And it was one of the worst performing assets last year. We think we've just kicked off the next phase of that bear market. Last week, dollar made a big move down. The president said he's fine with a weaker dollar. Quote unquote, look at all the business we're doing. Yes, that will help business, and it will help U.S. exports. It will help the translation of earnings from U.S. multinationals back into dollars. It'll help earnings. It will help exports, net exports. So it'll help GDP. It flatters a lot of things, and it makes the most important thing is it adds liquidity. It loosens financial conditions for everybody. So it's generally a very good thing for risk assets. And I'll touch a little more on why we think this is a big trend. We think by the time this bear market is over, the dollar will have depreciated 25 to 30% against a basket of other fiat currencies, whether you use the dollar index, the DXY, or the Bloomberg dollar index, which includes more emerging market currencies. Look, let's face it, the dollar's already devalued against gold in the last 2 years. Gold has doubled in the last 2 years. So we've had a devaluation against gold, and we think we're going to get the same thing against other fiat currencies as we go through 2026. Our last slide here is the Bloomberg Commodity Index total return. And you can see this is in a bull market. It's been in a bull market for years. It made a new high at the beginning of this year. And we think we're in a super cycle driven by underinvestment in key commodities. Remember, for years, these were uninvestable. ESG was holding sway. There were a lot of pensions, endowments, and institutional investors which wouldn't even touch commodity-oriented equities, and they darn sure wouldn't touch commodities themselves. We think commodities are really important for portfolios because they add diversification, they add inflation protection, and they give you the potential to generate returns outside of the two basic asset classes, equities and fixed income. We think this adds return and it lowers your risk. Those are all really good things. So just summing up our thoughts here, embedded in the report, I tried to narrow it down to the 5 or 6 key points here. Number one, last year was a really good year for investors, diversified investors, because the economy proved resilient, liquidity continued to flow. The U.S. economy did so well in the face of tremendous shocks. Earnings growth surprised to the upside, positive returns to almost all assets, generational bull market in commodities and precious and non-ferrous metals, and the dollar made its first move down by about 10% the first half of last year. It went sideways. We now believe we're beginning the next leg of the bear market. The fundamental backdrop as we head into the meat of 2026 remains constructive in our opinion. We've got booming economic growth. The Atlanta Fed GDP now is running north of 4%. That's blistering growth, my friends. The dollar is declining. Earnings are continuing to rise. Inflation is stable at worst and potentially grinding lower. The Fed is probably going to ease more in the second half of this year. Fiscal stimulus remains very robust. We're going to continue to run $2 trillion, 6-7% of GDP deficits. When you overspend by that much, it's very stimulative, and who knows what the politicians are going to come up with. President Trump is already recommending an extra $500 billion for defense spending in the budget. So we've got tax cuts on the way. We've got deregulation gathering steam, and we've got effective tariff rates likely to fall. You know, tariffs are anti-growth and pro-inflation. That's exactly what the administration does not need heading into the midterm election. So we think at the margin, quietly, tariff rates will fall to unwind some of that. And so we encourage clients to remain invested and to continue diversifying into international equities, small and mid-cap equities in the United States, cyclical, value-oriented equities in the United States. We see a rotation out of big cap tech and AI related into these, let's call it the revenge of the old economy, into things like chemicals and metals and down and dirty, cheap cyclicals. Those are booming this year. Commodities, as we just mentioned, an important part of any diversified portfolio, and alternative investments, which I'll get into in a second. We view high quality fixed income as a coupon clipping exercise. It's like it can generate mid single digit returns. Treasury bonds are in a very well-defined range between 375 and 475. We're likely to stay there this year, in our opinion, and we think that equities will outperform bonds in 2026. We expect the US dollar to continue to lose relative value in the year ahead. As the bear market for the dollar rolls on, we prefer other stores of value away from the dollar, such as precious and non-ferrous metals, commodities in general, the euro currency, the Japanese yen, Asian currencies, which are the cheapest in the world and are gathering momentum early this year, and even Bitcoin. Bitcoin's down almost 50%. Gold is up massively. Taking some money out of gold into Bitcoin probably makes sense. One's in a blow-off bull market, the other one's in a bear market. And more than at any time in the last decade, alternative investments compare favorably with public markets. Some people might wonder, well, why do I even need this? A 60-40 portfolio is fine. Well, you think about the starting point of the 60-40 portfolio, 60% equity, 40% bonds. I can make the case, a pretty strong case for mid-single digit returns for the next 10 years for that portfolio. If you're not investing in private markets, you're missing out on the lion's share of the US economy and certainly the global economy. So these vast, illiquid, and often misunderstood markets are currently out of favor. That's when we want to invest in them. And we're finding, as a firm, compelling opportunities across the spectrum of private equity, private credit, real estate, energy, and natural resources and infrastructure, and finally venture capital. We're finding other ways to get exposure to AI. So that's a part of the program where we can systematically diversify year after year into these 5 basic food groups, avoid the behavioral finance mistakes of selling at the lows and buying at the tops. We just do it systematically every year. So those are the takeaways from our 2026 outlook. We appreciate you listening. We appreciate your readership and business. And we wish all of you a very strong bit of returns in 2026. Thank you so much.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.